October 29, 1929. The New York Stock Exchange is in freefall. In a single session, $14 billion of market value vanishes. Banks collapse. Margin calls go unanswered. Men who were millionaires at 9:30 a.m. are broke by 3 p.m. The floor of the exchange sounds like a riot. The streets outside look like a funeral. And in a brokerage office on Fifth Avenue, one man sits completely still. Not panicking, not calling his broker in a frenzy, not liquidating in terror, collecting. By the close of trading on Black Tuesday, Jesse Livermore had made $100 million in a single day, shorting the crash. Every point the Dow fell, he got richer. In today's money, over $1.5 billion one day. Now here's the question that should be burning in your mind right now. How does a man see a crash coming when the entire financial establishment is blind to it? How does he position himself with enough size to capture that kind of return without getting wiped out during the months when the market kept going up before it finally broke? And here's the question nobody asks, the uncomfortable one. If he had the greatest risk management system in the history of American finance, why did he go bankrupt 3 times? Why did he die broke? This video is not about Jesse Livermore's biography. You can find that anywhere. This is about his system. The exact risk management principles he used to build and rebuild fortunes, the mechanics, the psychology, the rules, and critically, the specific ways those rules were broken and what that breaking cost him. Because the lesson here isn't just what the rules are, it's what happens when you know them and can't make yourself follow them. Stay with me. This is the most important video on trading psychology and risk that you cannot afford to miss. Let's start where Livermore started. Not with entry signals or chart patterns, but with a premise that most traders refuse to accept. The market does not owe you anything, and your opinion about what it should do is completely irrelevant. This sounds obvious. Every trader would nod at that sentence, and then go back to holding their losing position because they believe in the company, or averaging down on a stock that keeps falling because their analysis says it's undervalued, or refusing to cut a loss because admitting you're wrong feels like failure. Livermore built his entire risk management philosophy on one foundational observation. Most trading losses are not caused by bad analysis. They're caused by the inability to act on correct analysis. Read that again. You can be right about a trade, correctly identify the setup, the direction, the timing, and still lose money. Because you sized too big and got shaken out by normal volatility. Because you took profits too early out of fear. Because you let a small loss become a catastrophic one out of hope. The market is a machine that punishes emotional decision-making with brutal consistency. Livermore's risk management system was, at its core, a set of structures designed to take emotion out of the equation, or at least reduce its influence at the moments when it's most dangerous. Here's the framework he built. Every single element connects to every other. You cannot take pieces of it and expect it to work. It's an integrated system. The first thing you need to understand about how Livermore managed risk, and this is the foundation everything else is built on, is what he called the pivotal point. This is not a complicated concept, but the execution of it separates professionals from amateurs. A pivotal point is the price level at which, if broken in the direction of your thesis, the trade is confirmed as having high probability. And if that price level fails to break, or breaks and reverses, the trade is invalidated. In plain language, before you enter, you know exactly what the market has to do to prove you right, and you know exactly what it has to do to prove you wrong. Here's why this is the foundation of risk management, and not just an entry technique. When you define a pivotal point before entering, you are simultaneously defining your exit, because if the price level that justified your entry gets violated, the reason you're in the trade no longer exists. There is no logical basis to stay. Livermore described it this way. The pivotal point is where a stock is at a natural decision moment. Above it, the line of least resistance is up. Below it, the line of least resistance is down. You enter when the stock crosses that line with conviction, and you exit without hesitation if it crosses back. The mechanical discipline this creates is enormous. You are no longer making an exit decision under emotional duress. You made it in advance, in cold blood, before a single dollar was at risk. Modern risk management calls this a predefined stop-loss. But for Livermore, it was more conceptually robust than that. It wasn't just a number, it was a logic gate. The question isn't where do I put my stop? The question is, what price action would definitively tell me my thesis is wrong? That's the number. That's the exit. And here's what makes it hard. Once the trade is on, you cannot negotiate with that level. You cannot decide the stop is too tight because the position has moved against you and you don't want to take the loss. You cannot widen it to give the trade more room. The rule is set, the rule is followed. The rule is, Livermore's bluntest statement on this, losses never bother me after I take them. A man who is always making mistakes is not fit to be a speculator, but anyone can make a mistake. And when the mistake is recognized as such, the remedy is simple. Accept it and get out. Accept it. Get out. Simple. Extraordinarily hard. But identifying the right entry is only half of it. The second thing Livermore did, and this is where he separated himself from almost every other trader of his era, was how he sized into a position. This is where Livermore's system gets truly sophisticated and where most traders, even disciplined ones, make their biggest mistakes. When Livermore identified a pivotal point and decided to enter a trade, he did not put his full intended position on immediately. He probed. He would take a small initial position, typically 20% to 25% of the total size he eventually wanted, and wait. If the trade moved in his direction, if the market confirmed the thesis, he would add a second tranche, then a third. Each addition made only after the previous one was showing a profit. He called this pyramiding, building a position like a pyramid, narrow at the base, expanding as confirmation accumulates. Let's think through the risk mechanics of this approach, because they're not obvious at first glance. If you probe with 20% of your intended size and the trade goes against you immediately, your loss is 20% of what it would have been if you'd entered full size. Small, manageable. You exit at the pivotal point, take the loss, move on. If you probe with 20% and the trade goes in your direction, now you have market confirmation that your thesis is directionally correct. You add a second 20% at a slightly higher price. Now you have a 40% position and your first tranche is already showing profit, which partially offsets any adverse move. If the trade continues in your direction, you add a third tranche, now 60%. The market has confirmed your thesis 3 times. You are scaling into a winner, which is exactly what you want to do. Here's the genius. Your average entry price is never at the very beginning of the move. It's somewhere in the middle. This means your risk on any individual tranche is defined and small, but your exposure to the full magnitude of the move grows as the move confirms itself. You are using the market's own movement to de-risk the position as it builds. Contrast this with what most traders do. They identify an opportunity, they get excited, they put their entire intended position on at once. Now if the trade moves against them, even temporarily, they're fully exposed with full emotional pressure to either hold through pain or exit at maximum psychological stress. Livermore's pyramiding approach kept him from making that mistake when he was disciplined, and the times he abandoned it were the times he got into trouble. The corollary rule, and this is equally important, is that he never added to a losing position. Never. Not once, not under any circumstance. This is called averaging down, buying more of something as it falls because you believe it's an even better deal at the lower price. And it's one of the most seductive and destructive patterns in all of investing. Here's why it's so dangerous. When a position is moving against you, you don't know if it's going to turn around at 10% or continue to 50%. You only know that the market currently disagrees with you. Adding more capital to a position the market is voting against is not conviction. It's doubling down on uncertainty. Livermore was brutal on this point. It is not wise to try to average a loss. Always close out what shows you a loss and keep what shows you a profit. Cut what's wrong, add to what's right. This principle is so fundamental that it appears in virtually every serious risk management framework ever developed. From modern portfolio theory to Ray Dalio's all-weather strategy to the position sizing work of Van Tharp. But Livermore was practicing it intuitively in live markets over a century ago. Now we have to go somewhere uncomfortable, because everything in Section 1, the pivotal points, the pyramiding, the rules about cutting losses, all of it is intellectually simple. You can understand it in 20 minutes. You can write it on an index card and tape it to your monitor. And you will still break every single one of those rules the moment markets put real pressure on you. Livermore knew this. He studied it in himself and in every trader he'd ever watched succeed or fail. He identified 4 specific psychological forces that destroy even disciplined traders. And he spent more time writing about them than he did about any technical element of trading. He called them the 4 enemies of the speculator. The first enemy is hope. And I don't mean hope in the way we normally think about it. Hope is not a virtue in trading. In trading, hope is a slow bleed. Here's how it works. You're in a position. It's moving against you. Your pivotal point, the level you told yourself would end the trade, has been hit. The logical action is to exit. But instead you do something else. You renegotiate, you start telling yourself a story. Maybe it bounces from here. The earnings report is next week. That'll be the catalyst. I've already held this long. I can wait a little longer. The market is being irrational. My thesis is still right. Every one of these sentences is hope in disguise. And every one of them is a lie you tell yourself to avoid taking a loss. Livermore had one of the most precise formulations of this I've ever read. The speculator's chief enemies are always boredom from within. It is inseparable from the desire to carry a trade just a little longer, hoping for bigger profits. And in another context, more bluntly, it is not the thinking that wins. It is the waiting and the acting at the right moment. Hope causes men to wait in the wrong positions. The moment you start hoping instead of evaluating, you've stopped trading and started gambling on your own narrative. Here's the practical consequence of hope. A 5% loss becomes a 10% loss. A 10% loss becomes a 25% loss. A 25% loss becomes a position that has destroyed 50% of your capital in one trade, leaving you not just financially damaged, but psychologically broken, unable to execute properly on the next opportunity, because you're so desperate to get back what you lost. Livermore's antidote to hope was architectural. He removed the decision from the moment of emotional pressure by making it in advance. The exit is predetermined. The loss is accepted as the cost of being wrong. When the level is hit, the trade is over. No renegotiation, no hope required. This is why professional trading firms build hard stops into their systems. Not because traders aren't smart enough to know when to exit, but because in the moment of pressure, the smartest trader in the world will negotiate with themselves if given the chance. Remove the chance. Fear cuts the other direction, and it's just as destructive, maybe more so because it robs you of wins you already earned. Fear is hope's mirror image, and it kills your gains the same way hope kills your losses, by disrupting rational decision-making at critical moments. When you're in a winning trade, when the position is profitable, when your thesis is playing out, fear whispers, take it now. Something could go wrong. A news event could reverse everything. You'll regret it if you don't lock in the profit, so you sell at a 15% gain and the stock goes on to deliver 150%. This is not hypothetical. This is the single most common way that traders who are right about a trade still end up losing money over time. They cut winners short and let losers run. The exact opposite of what sound risk management demands. Livermore was emphatic about this. The big money in any market is made in the big moves. And the big moves require you to hold through volatility that feels genuinely frightening. He wrote, "It was never my thinking that made the big money for me. It was always my sitting. Men who can both be right and sit tight are uncommon." Sitting tight means holding a winning trade through normal pullbacks, through the 5%, 8%, 10% retracements that markets make on the way to a much larger move. Those pullbacks feel real. They feel like reversals. Fear tells you they are. Livermore's antidote. Define price targets before the trade, the same way you define stop losses. If your analysis says a breakout should run to a specific level, commit to that level. Don't exit at the first 10% because you're afraid. Don't tighten your stop so aggressively that a normal pullback kicks you out before the real move happens. He had a precise rule about stops in winning trades. You can move a stop in your favor, trailing it up as the position gains, locking in more profit as the move progresses, but you never move a stop against your position. You never widen it to give yourself more room. If a winning trade reverses back to your original stop, that tells you the move is over. You exit at your predefined level. The discipline to let winners run while maintaining predefined exits is, in Livermore's framework, the entire ballgame. Almost everything else is secondary to mastering this one dynamic. The third enemy is subtler than the first two, and most traders never even recognize it as a risk management problem. Livermore called it ignorance, but he didn't mean stupidity. This one is subtler, and it's the one most modern traders don't think of as a risk management issue, but it absolutely is. For Livermore, ignorance didn't mean being unintelligent. It meant operating without understanding the broader market environment you were trading in. He believed deeply that individual trade outcomes are heavily determined by macro context. A long setup in a bull market has very different probability than the exact same setup in a bear market. A breakout in a rising tide environment gets follow-through. The same breakout in a deteriorating market gets sold into. Livermore spent enormous time understanding the macro picture. He followed Federal Reserve policy, credit conditions, industry cycles, commodity supply, and demand. He was synthesizing top-down analysis before the term existed in finance. From a risk management perspective, this context determines several things. First, how aggressive to be. In strong bull markets, he was willing to pyramid larger positions and hold through bigger pullbacks. In deteriorating conditions, he'd take smaller initial probes and tighten his exits. Second, which direction to trade. He was famously comfortable shorting, something most investors refuse to consider, because he understood that markets can fall as dramatically as they rise. Ignoring the short side isn't just limiting your opportunity. It's a form of ignorance about how markets actually work. Third, when to do nothing. This is the most radical and most important application of the context principle. Livermore had extended periods where he did absolutely nothing, no trades, just held cash and watched. He called these periods waiting for the right pitch, and he was unapologetic about them. There is a time to go long, a time to go short, and a time to go fishing. Cash is a position. Inactivity in the wrong market environment is not a failure. It's sophisticated risk management. The refusal to force trades when conditions don't meet your criteria is what separates capital preservation from slow death by 1,000 cuts. Most retail traders can't do this. They feel compelled to be in the market. They feel like missing a day of trading is missing an opportunity. This compulsion to always be doing something is one of the most reliable ways to give your money to people who are more patient than you. And then there's the last one, the most dangerous one, because it doesn't feel like an enemy and it feels like confidence. Greed is the most insidious of the four enemies because it disguises itself as confidence. For Livermore, greed didn't manifest as "I want more money." It manifested as systematically violating the rules of his own system in pursuit of bigger gains. It showed up in two specific ways. Overtrading. When things were going well, say when he'd had a profitable run, the temptation was to find more trades, trade bigger, extend the winning streak. But the market doesn't have a winning streak mode. It has high probability setups and low probability setups. Forcing trades beyond what your system identifies is overtrading. It turns a skilled methodology into noise. Livermore noticed that many of his worst periods came directly after his best ones. The confidence from a big win led to larger bets in lower quality setups, which erased the gains. The revenge trade. After a losing streak, the desperate impulse to make it back in one large decisive trade, to go big, to recover everything at once. This is the trade that ends careers. Livermore was clear. After significant losses, the correct response is to stop, not trade smaller. Stop entirely. Step away from the market. Give your brain time to recover from the cortisol flood of consecutive losses. Come back when you can see clearly. He knew, and modern neuroscience has since confirmed, that the brain in a losing streak is literally not functioning at its normal capacity. Stress hormones suppress the prefrontal cortex, the part responsible for long-term planning and rule-following, and amplify the amygdala, the part responsible for reactive, survival-oriented behavior. You don't just feel worse during a bad run, you are cognitively impaired. You are biologically incapable of making the same quality decisions you could make in a neutral state. Trading through that impairment is not discipline, it's self-destruction with a brokerage account. All right, let's get out of the abstract and into the actual, because the best proof of this system isn't theory. It's watching it execute in real markets against some of the most dramatic events in American financial history. The first trade worth understanding is the panic of 1907. In early 1907, Jesse Livermore started seeing things in the market that made him deeply uncomfortable about the long side. Credit conditions were tightening. Certain speculative positions, particularly in copper, were becoming dangerously over-leveraged, and most tellingly, the tape was showing him something he'd learned to pay close attention to. Stocks were having trouble going up. Good news was being released, earnings were solid, the business press was optimistic, but stock prices weren't responding the way they should in a healthy bull market. They'd rally briefly on positive news and then fade. Volume was picking up on down days. The line of least resistance, in Livermore's language, was shifting. He started probing short positions, small initial positions, consistent with his pivotal point methodology. He was testing the thesis, not betting the farm on it. And initially, the market bounced. His first probe was wrong directionally. He lost money on that initial position. Here's the critical moment, and this is where most traders would have reversed course entirely. The loss on the initial probe proved the thesis was wrong. The conventional wisdom was still bullish. Every major operator on the street was dismissing the warning signs. Livermore re-examined his analysis. The underlying conditions that generated the thesis hadn't changed. The tape was still showing distribution. The pivotal points were still intact. He held the thesis. He sized down slightly to manage risk on the uncertainty. He waited. The panic of 1907 broke in October. The Dow fell nearly 50% from its peak. Banks across the country failed. The financial system came within days of complete collapse, only stabilized by J.P. Morgan's personal intervention and his emergency organization of bank rescues. Livermore was short the entire way down. His profit on the 1907 crash, approximately $1 million in 1907. The risk management lesson is layered here. 1. He used small probe positions to test a thesis before committing full size. Initial losses on those probes were contained and manageable. 2. He did not abandon a valid thesis because a small initial position lost money. He distinguished between the trade moved against me temporarily and the premise of the trade is wrong. 3. He added to the position only after the market confirmed the direction, after the break began. He didn't try to call the exact top. He entered, confirmed, and pyramided on the way down. 4. When J.P. Morgan stepped in and announced the stabilization of the banking system, Livermore covered his shorts immediately. New information had entered the picture. The macro premise of the trade had changed. He didn't fight the new reality. He adapted and exited. That fourth point is one of the most underappreciated aspects of his risk management philosophy. When the fundamental premise of your trade changes, you exit, regardless of where you are in the trade, regardless of profit or loss. The premise changed. The trade is over. But the trade that might teach you the most about Livermore's risk management is actually one most people have never heard of. This is a lesser-known Livermore story, but it might be the most important one from a pure risk management perspective. In the early 1920s, Livermore took a large, long position in cotton. He'd done his analysis, identified what he believed was a major supply shortage developing, and had positioned accordingly through his pyramiding approach. The trade started working, he added, then added again. He was building toward what he thought could be a historic move. And then an old acquaintance, a man Livermore trusted, a man with connections in the cotton industry, quietly approached him and suggested the supply picture had changed, that a government report was coming that would show more supply than the market expected, that the big move Livermore was anticipating wasn't going to happen. Livermore acted on the tip. He liquidated his cotton position. The government report was released. Cotton crashed. Livermore's source had been right, but here's what Livermore wrote about it afterward, and this is the part that reveals everything about his risk management psychology. He was furious with himself. Not because of the result, he'd avoided a huge loss, but because he'd violated his most fundamental rule: never act on anyone else's information, trust only the tape. He wrote, "I had broken my own rules. I had let outside information override my own analysis and the message of the market itself. Even though it worked out this time, I knew it was wrong. You cannot build a methodology on someone else's judgment, because you cannot control someone else's judgment. You can only control your own process." He understood that the exception that worked was more dangerous than the exception that failed, because it taught him that breaking the rules was sometimes okay. It wasn't okay. It was lucky. This is one of the most sophisticated risk management insights I've encountered anywhere in trading literature. A rule broken with a good outcome is still a broken rule, and a broken rule repeated is eventually a catastrophe. And then we come back to where we started. By the late 1920s, Livermore had been watching the speculative excess build for years. He wasn't ignorant of it, but he also wasn't positioning against it prematurely, which would have been as dangerous as ignoring it. He was watching the tape. And in 1929, the tape started showing him something he'd seen before. Not in the news, not in the economic fundamentals, which were still being reported as strong, but in the price action itself. Stocks were making new highs with declining volume. Distribution patterns, where large players quietly unload positions into retail buying, were showing up across multiple sectors simultaneously. The line of least resistance was beginning to shift. He started building short positions in early 1929. Slowly, probe positions, small initial sizes. The market kept going up. For months, his positions lost money. People in his circle, advisors, associates, people who knew his methods, told him he was wrong, that the economy was fundamentally sound, that this bull market was different. He held the thesis, not because he was stubborn, because the underlying conditions that generated the thesis, over-leverage, thinning volume on rallies, distribution patterns, had not changed. The pivotal points that would have told him he was wrong had not been violated. The market confirmed in October 1929, then confirmed again. Then the bottom fell out entirely. He pyramided the entire way down, adding short exposure as each new breakdown confirmed the direction, building a position that grew larger only as the market proved him right, the exact structure of his entire methodology. $100 million in profit, from a short position built with probe entries, confirmed with pyramiding, held against enormous psychological and social pressure, and managed with predefined exits at every stage. But here is the piece of this story that matters most for understanding what Livermore's system actually was. After the crash with $100 million in hand, he gave multiple interviews in which he described exactly what he'd done: the pivotal points, the probing approach, the pyramiding, the discipline of holding through the uncomfortable early period when the market was still rising against him. And then he said something remarkable. "The rules I followed in this trade are the same rules I have always followed. The question is never whether the rules work. I know they work. The question is whether I will follow them next time." He was already worried about himself. He had $100 million. He had just pulled off the greatest single trade in American market history, and he was already afraid of what he knew about his own psychology. He had reason to be. This is the section most financial content skips, or mentions in one sentence as a footnote, but it's not a footnote, it's the whole point. Because the story of Jesse Livermore's collapse is not a story about bad luck or a market that turned against him. It's a story about systematic rule violation, about a man who knew precisely what he was supposed to do and couldn't make himself do it. And that story is more relevant to your investing life than anything in Section 1. The first crack appeared in the one rule Livermore had held sacred longer than any other. After 1929, Livermore's world changed in ways that were easy to see and hard to manage. He was the most famous trader alive. Everyone wanted access to him: investors, business people, operators. His social circle expanded dramatically. He was surrounded by people who had opinions about markets, who had information, who had relationships in industries and companies that they believed gave them an edge. And gradually, insidiously, Livermore started listening. Not all at once, not obviously. It crept in. A tip here. An acquaintance's read on a situation there. Slowly, the process that had made him the cold, tape-based methodology that trusted nothing except price action started being contaminated by external input. He began acting on information from people he believed were credible. Sometimes they were right. Sometimes they were spectacularly wrong. And when they were wrong with Livermore's money. His own rule, the one he'd articulated for decades, the one he'd written about, the one he'd taught, stated unambiguously, never take information from anyone. The tape is the only legitimate source. He knew the rule. He knew he was breaking it. He did it anyway. Why? This is where we have to be honest about something that most financial education refuses to touch. Success is a risk factor. After 1929, Jesse Livermore was operating under conditions that made disciplined rule following psychologically harder, not easier. He had enormous wealth, which reduced the fear of loss that had kept him disciplined when he was building. He was surrounded by people who deferred to him, which inflated his confidence beyond what his process supported. His reputation meant every loss was a public event, which created social pressure to find reasons to stay in bad trades, rather than admit he was wrong. These are not excuses. They are mechanisms. Understanding them is crucial for any serious trader or investor, because the same dynamics operate at every level of capital, scaled up or down. And then came the moment that should stop every trader cold. In the early 1930s, after 1929, after the greatest triumph of his career, Jesse Livermore began averaging down on losing positions. He bought more of positions that were moving against him. He violated the principle he had held sacred for over 2 decades, the principle he had specifically warned against in print, the principle he had watched destroy countless other traders. He averaged down. The specific trades were in commodity markets primarily: cotton, grain, positions where he believed his analysis was correct and the market was temporarily wrong. The market continued to disagree with him, and the larger those positions got, the more capital he deployed into confirming losses, the harder it became to exit, because now the loss wasn't just financial, it was identity-threatening. To exit a massively averaged down position was to announce to himself and to the market that Jesse Livermore, the greatest speculator of his era, had been catastrophically wrong. So he held. The losses compounded. In 1934, he declared bankruptcy, his fourth, with debts exceeding $2 million and assets that couldn't cover them. The man who had made $100 million in 1929 was broke 5 years later. Let that sentence sit for a moment. $100 million, 5 years, broke. This was not the market punishing him. The market was simply enforcing the consequence of broken rules, the rules that his entire methodology was built on: cut losses, never average down, trust the tape above all else, had been systematically violated. And the result was mathematically predictable. So what actually happened inside Jesse Livermore's psychology between 1929 and 1934? Because this is where the story gets truly important. We don't have a full clinical picture, but we have his own writings, and they are devastating in their self-awareness. He knew what he was doing wrong. He could articulate it precisely. He wrote about it in the very period when he was doing it. This is not a story about ignorance. This is a story about the gap between knowing and doing, and how that gap under pressure can swallow everything you've built. Modern behavioral finance has a name for what happened to Livermore. Several names, actually. Loss aversion. Humans feel the pain of a loss approximately twice as intensely as the pleasure of an equivalent gain. This means that when Livermore was facing large losing positions, the psychological pain of recognizing and realizing those losses was almost unbearably intense, even for a man who had been cutting losses his entire career. Sunk cost fallacy. The more capital you've deployed into a losing position, the harder it becomes to exit, because your brain treats the invested capital as a reason to stay, when rationally it should be irrelevant to the exit decision. Identity threat. Livermore's professional identity was inseparable from his trading record. Admitting a catastrophic loss wasn't just financially painful, it was an existential challenge to who he believed he was. Combine these three forces with a post-1929 social environment where his status demanded he appear confident, where cutting and running from large positions would be very public, and you have a recipe for exactly what happened. He held. He averaged down. He broke every rule he'd built his career on, and it destroyed him. All right, let's take everything Livermore built and everything he destroyed and make it actionable. Because this isn't history. Every dynamic we've discussed is operating in your portfolio right now. Let's take everything Livermore built and everything he destroyed and make it actionable. Because this isn't history. Every dynamic we've discussed in this video is operating in today's market, in your portfolio, in your decision-making right now. The first thing you can implement today. The single most impactful thing you can take from Livermore's methodology is this. Every trade decision must be made before you have money at risk. Before you enter any position, you need to answer 5 questions. 1. What is the pivotal point? The specific price or condition that confirms my thesis is correct and justifies entry. 2. What price proves me wrong? This is your exit. Write it down. It does not change after you're in the trade. 3. What is my initial position size? Given that the trade might fail immediately, how much can I lose on this probe without it materially affecting my overall capital or my ability to execute the next trade? 4. At what price do I add to the position? Specifically, what confirmation does the market have to give me before I increase exposure? 5. What is my target? Not I'll hold until it feels right. A specific level or condition that tells me the trade has played out. These 5 questions, answered before a single dollar goes in, make up Livermore's entire risk architecture. Every rule he had maps back to one of these 5 questions. If you can't answer all 5 before entering, you're not ready to enter. The second piece, position sizing, is not an afterthought. It is not how much do I want to make. It is the primary mechanism by which you survive long enough to be right. Livermore's probe approach, starting with a fraction of intended size and scaling only on confirmation, protects you from a specific and common failure, being right about the direction but wrong about the timing. Markets can take longer to do what you correctly predict they'll do. If you're fully positioned at the beginning, the volatility of being early can shake you out before the move materializes. If you probe, your early losses are small and you're still in the game when the thesis plays out. The practical rule. Your initial probe should never be large enough that losing it entirely is psychologically significant, because you need to be able to take that loss without it affecting your next decision. Emotional damage from position losses is a real factor that degrades future performance. Size your positions so that being wrong doesn't break you. That's not timidity. That's the math of staying in the game long enough for your edge to play out over time. Now here's the one nobody wants to do. The hardest rule in Livermore's system, the one with the highest opportunity cost in the short term and the highest return in the long term, is knowing when not to trade. You need to identify in advance what market conditions don't meet your criteria. What does a choppy, directionless market look like in measurable terms? What does the macro environment is too uncertain to justify large positions look like? If you can define those conditions before they arrive, when you're calm and clear-headed, you can make a rule. In these conditions, I don't trade. or I reduce position sizes by 50%, or I only take setups that score above a certain threshold on my system. Having a rule you execute in advance is categorically different from deciding in the moment that this market doesn't look great, because in the moment you're subject to all four enemies Livermore described. Fear, hope, ignorance, and greed will all push you toward trading when you shouldn't. Write the rule when you're calm. Execute it when you're under pressure. That's the whole discipline. Fourth, and this is the structural piece. Here's the hardest truth in this entire video. Knowing the rules is not enough. Jesse Livermore proved that. He knew every single thing I've told you in this video. He wrote most of it. And he still broke those rules when the psychological pressure was high enough. You will too. I will too. Every trader and investor alive will at some point negotiate with their own rules when it costs them most. The solution is not trying harder to be disciplined. The solution is building external structures that enforce the discipline for you. In practical terms, use hard stops in your brokerage account. Mechanical orders that close positions automatically at your predefined levels without requiring you to press a button. You cannot negotiate with a mechanical stop. Use position limits that are coded into your system. Not guidelines, but hard limits that require an active override to breach. Create a pre-trade checklist. Those 5 questions from application 1 that you literally must complete and record before any trade is entered. Not because you don't know the questions, because having to write down the answers forces a quality of deliberation that reviewing them in your head doesn't. Find an accountability partner, someone whose job it is to look at your trades and ask you, did you follow your rules? Not to give you their opinion about your trades, just to ask that question. The goal of these structures is to make breaking your rules require active, effortful decision, not just a quiet internal negotiation. The harder you make it to violate the rules in moments of pressure, the more likely you are to follow them. And the last one, the one Livermore himself never figured out how to protect against. This is the Livermore lesson that nobody teaches, and it might be the most important one. After a major win, after a period of strong performance, your risk goes up. Not because the market has changed, but because you have. Confidence built on a hot streak is not the same as confidence built on a consistent process. The former leads to larger bets, lower quality trade selection, and reduced discipline on entries and exits. It leads to what happened to Livermore after 1929. When things are going well, that is the moment to tighten discipline, not loosen it. Review your rules. Reduce position sizes slightly if you find yourself finding trades everywhere. Be more demanding of setups, not less. The market will eventually offer you a situation designed to take back what it's given you. The only protection is having the same process during the winning period that you had during the building period. Livermore earned $100 million and lost it because success changed him in ways he couldn't see clearly. That's not unique to him. It's a pattern repeated across market history. Know that it's coming. Build defenses against it now. Jesse Livermore's risk management system was not complicated. Define your pivotal points. Probe first, confirm before adding. Cut losses without negotiation. Let winners run to predefined targets. Trade with the macro environment. Do nothing when conditions don't merit a trade, and never under any circumstances add to a losing position. 7 principles. He articulated them clearly, practiced them successfully for decades, and made $100 million in a single day executing them at the highest level any trader ever has. And he still couldn't follow them consistently enough to keep what he built. That is the real lesson here, not the rules themselves, but the fact that knowing rules and following rules are 2 entirely different skills, and the second is harder than anything else in investing. Livermore's greatest trades weren't about brilliance. They were about discipline applied at moments when every human instinct said to do something else. His worst trades weren't about stupidity. They were about what happens when that discipline fails, when the rules get negotiated away one concession at a time, under pressure, with everyone watching. The question this video leaves you with is simple. What rules do you have for your own capital? Not guidelines, not general principles, specific, written, pre-committed rules with external structures that enforce them when your willpower is weakest. Because the market doesn't care how smart you are. It doesn't care what you know. It cares only about what you do, specifically what you do in the moments when doing the right thing is hardest. Jesse Livermore knew the answer his entire career. The gap between knowing and doing is where fortunes are made and lost. Mind that gap. If this is the kind of content that makes you think differently about markets, not tips, not predictions, but the deeper mechanics of how legendary traders actually operated, then this channel is built for you. LCBooks and Life goes deep on the figures who shaped modern finance. Soros, Druckenmiller, Paul Tudor Jones, Ed Seykota. Each one a different lens on the same fundamental questions. How do you manage risk? How do you think about probability? How do you build a mindset that survives long enough to compound? If that's what you're here for, subscribe. Every video is built like a financial documentary, not a highlight reel. And if Livermore's system resonated with you, read his books directly. Reminiscences of a Stock Operator by Edwin Lefebvre and How to Trade in Stocks. Livermore's own words written in 1940. Both links are in the description. He wrote the rulebook. The rest is up to you.